Let's talk about what's happening in the global financial markets over the past 24 hours. In the past day, financial markets have been caught between hope and fear. United States stocks barely moved as investors weighed the possibility of future interest rate cuts against rising tensions in the Middle East. The main story is a tug-of-war. On one side, the central bank is signaling it may cut rates if needed. On the other, there's the risk of a wider conflict that could send oil prices and inflation higher. European markets performed better, helped by their own central bank actions, while bond markets flashed warning signs with a weak United States 20-year bond auction. The United States dollar slipped a bit but remains a safe haven if global risks escalate. Overall, markets are indecisive, waiting for a clear signal on which way things will break. The United States Central Bank kept interest rates steady, as expected, and described the economy as solid but uncertain. The chair highlighted concerns about inflation from new tariffs, saying the bank will wait for more data before cutting rates. This gives the bank flexibility and helps it avoid political pressure. Despite this caution, the bank still projects 2 rate cuts by year-end, and markets now see a higher chance of a cut in September. In Europe, the main central bank recently cut rates and is now in wait-and-see mode, depending on new data. The United Kingdom's central bank also held rates, but a growing number of members want to cut, making a rate cut in August more likely. In Japan, the central bank kept rates unchanged and lowered its growth outlook, pushing any future rate hikes further out. Switzerland's central bank cut rates again, reinforcing the global trend of diverging central bank policies. Looking at the plumbing of the financial system, there are no signs of acute stress, but conditions are tightening. The central bank's emergency lending tools are barely being used, showing no immediate crisis. The government's main account at the central bank dropped slightly, adding a bit of liquidity to the system. The overall money supply has ticked up a little, but the longer-term trend is flat or shrinking, reflecting tighter policy. The real concern is the weak demand for new government bonds, especially the 20-year bond, which suggests private investors are less willing to buy at current prices. If this continues, it could cause disruptions in funding markets. Meanwhile, money market funds are seeing steady inflows as investors prefer safe cash-like assets. United States stocks ended the day flat, with technology and utilities doing well, but energy and communications lagging. A major payments company dragged down the blue chip index. In Europe, stocks rose, helped by central bank easing. In Asia, Japan's market slipped on a cautious outlook, while Hong Kong's market rallied. The key point is that Europe is benefiting from easier policy, while the United States is more sensitive to geopolitical risks. In the bond market, the yield curve remains inverted, which is often a warning sign for recession. The weak 20-year bond auction stands out, as the government had to offer higher yields to attract buyers, and the central bank had to step in and buy a chunk of the bonds. This shows that funding conditions are getting tougher, and if it continues, it could push long-term rates higher, slowing the economy. The United States dollar weakened slightly as the central bank signaled patience, while the euro and British pound gained. But this dollar weakness could quickly reverse if global risks flare up. Oil prices fell, as growth fears outweighed supply risks, and gold also dropped, as investors preferred cash over non-yielding assets. In the options market, there was unusually heavy activity in a financial services company, with a huge spike in call option buying. This often signals expectations of a big positive event, like a merger or strong earnings. There was also bearish activity in a biotechnology company, with lots of put options traded. Recent regulatory filings showed a sudden resignation of a chief financial officer at a biotech firm, which is often a red flag for investors. Another company released new financials after a big acquisition, giving investors a first look at the combined business. So what can we do and how can we navigate these markets? Looking ahead, the market's next move will likely depend on how the United States-Iran situation unfolds. If tensions escalate, expect stocks to drop, volatility to spike, the dollar to surge, and oil prices to jump. If things calm down, markets will refocus on inflation and central bank policy, likely resulting in sideways or slightly higher stock prices and a weaker dollar. For investors, some strategies stand out. To hedge against geopolitical risk, consider energy stocks, which would benefit from higher oil prices. If central bank policy divergence continues, the British pound could strengthen against the dollar. For those seeking more speculative opportunities, the unusual options activity in the financial services company could signal a big move ahead. Finally, the sudden chief financial officer departure at the biotech firm is a classic warning sign and could present a short-term trading opportunity for those willing to take the risk. The link to the daily interactive financial dashboard is below. Please comment and follow.